After a series of sizable rate cuts to help calm the credit crisis roiling financial markets, the Federal Reserve has drawn a line in the sand and left a key rate unchanged.
Well, frankly, a quarter point one way or the other doesn't make a lot of difference, except for the fact that it would shock the markets. But other than having a lot of surprised people walking around Wall Street, I don't think it'd have much impact on the economy.
The decision signals an end to an 8-month-long campaign of rate cuts designed to spur consumer spending and economic growth. The central bank announced that it was keeping the federal funds rate, the interest rate that banks charge each other, at 2%. It marks the first time in 10 months that it has failed to reduce interest rates at one of its regular meetings.
They're sort of stuck right now. I don't think they can lower rates anymore unless they're sure that inflation isn't a problem. But on the other hand, with growth this week, I don't think they can afford to raise them either.
When it last met in April, the Fed lowered rates a quarter point, leaving the key federal funds rate at 2%. In September, the funds rate, which banks charge each other for overnight loans, stood at 5.25%. Today's decision by the Fed effectively leaves the prime lending rate, the benchmark for millions of business and consumer loans, at 5%, the lowest since late 2004. Mark Hamrick, The Associated Press.